Hi, this is Keith. I'm just going to do a quick run through of a bunch of things that I think are important to make note of with the new Earnings Edge capability. Again, I've been diving deep into this one, a great new addition to the tool set here. I think a lot of people are excited about it like me. I've spent quite a bit of time and generated a bunch of questions for myself and kind of been through the process of coming to some conclusion or some understanding of some of these things. And all I wanted to do is just kind of share what I think are some key things to make note of. You may disagree with the importance of some of these, or you may disagree to the conclusions. I'm not looking for a response to this, so no need to respond, no need to answer me on this. The only reason I'm sharing this is because I've been through the process of developing and understanding this tool. I've come to some conclusions that I'm going to share. You do your due diligence. You focus on these particular areas if you also think they're important to understand, and draw your own conclusions. So hopefully this is helpful. I'm just going to run and gun through these, not going to explain it in a lot of detail. For Oracle here, and I've just filtered by Oracle, they've got earnings coming up most immediately. They're reporting earnings on Tuesday after the market closes. So, as per the backtest rules, just wanted to clarify, all of these trades are going to have an expiration of this coming Friday. And as per the backtester and as per some of this data here, the average move, the duration that it's sort of testing here is from, the close, I guess, immediately prior to that earnings event. So in this case, from the close on Tuesday prior to earnings to that following Friday. So that's the trade setup here. If you're going to enter these trades, you'd be putting these trades on a Tuesday afternoon. You'd hold till expiration on Friday. So that's your first point of clarification. Other one here, rate of return is the default sort order. And I think it confused me a little bit in terms of how is it possible that we have a risk chart that looks like this, right? We've got a ton of green, very little red, a reward risk ratio of 19-1. How is that possible that we have such a high probability, right? Our probability of max profit is 75%. So that looks really, really, too good to be true. And it is, okay? So if you've been trading credit spreads, iron condors, hopefully you've been told that you should not be trading around earnings, right? These trades do not behave very well when we have potential for kind of outlier moves or very high implied volatility. Unusually high implied volatility, right? So, we would want a different strategy for those types of events. So, not just the earnings, but even if Oracle were to have some news event coming up, they've scheduled some announcement of some new product, and there's a lot of anticipation for that product. You wouldn't want to be putting on a trade like this in advance of that, unless you had a very specific view on what you think the outcome of that event will be. Again, whether it's a reaction to that new product or a reaction to that earnings report. So don't be looking at these percentages. These aren't relevant for this type of trade. It's a very speculative bet. We need to form some opinion as to what we think the stock price is going to do. In this case, we want to look more at implied volatility, which is going to drive our expected move. So here, just looking at the platform, again, different platforms are going to show potentially different percentages. So just need to be comfortable with your understanding of this expected move. This is, again, derived based on implied volatility. So this is a sort of current view today from now until expiration. So this is before the market opens on Monday, so we still have 5 days of price move built into this expected move. This average move, again, depends on their historical record of reporting earnings, but assuming that they always report early in the week, let's say on a Tuesday after the market closes, then that would be a move of 4 days, right? From the earnings report until that Friday expiration. So these percentage moves or dollar price moves are the more relevant kind of information. And what is the opinion that's expressed with this particular trade, and why is it such a low probability? Well, we can see here the opinion is that Oracle from now, again, this is also similar to expected move. This is showing you the current, based on the current pricing of these options with 5 days of potential price move built in. between now and expiration, it's predicting a 3.1% move. And that is very different from our expected move and our average move. So that's where we're getting that risk reward. Our probability of a 3% move based on some of the information we're seeing here is again not likely. We can drill in on the back test here, and we can see maybe a little bit more detail in terms of that average move. Just keep in mind this is showing price move, dollar price move. So this is not on a percentage basis. This is not a logarithmic scale. So it's hard to visualize what the actual percentage move is on these charts. But if we wanted to just look at the last 4 quarters, we could just look at these percentages here. Again, I'm looking at that end of week. That is, again, that move till expiration. So that 4 DTEs. It looks like these are 4 DTE trades. Again, just another thing to confirm is just make sure that historically they're on the same schedule and that these are, consistently trading the same spread that you're following here as well. So we've got plus 10, minus 10, minus 10, plus 7.8. So those are just the 4 most recent. You can see there are pretty large moves. The green shaded area, red shaded area is kind of showing those moves. But again, that's on a dollar basis. We've got a stock trading at $120. So this dollar move is going to be less of a percentage than this move here, this distance at $40, right? So again, if you're looking at sort of interpreting a percentage basis, this isn't the chart to look at. Again, we can look at the data in the underlying thing here. Actually, we can go down to March. That's a 20% move. So again, not visually, you can't tell that from the chart. You actually need to look at the data or look at the other screen. I'll show you in a minute where we can find that the percentage graph. The other thing we don't see here, actually I saw this one is 1 DTE, so opened on March and closed on March 14th. So I don't know how relevant that is. It's just calling that out that there's a back test and this sort of average, where is it? Average move is, again, depending on earnings, it may be a different duration, right? So it's averaging a mix of different things here or there, and just to keep that in mind. Again, not all that relevant, just calling it out. We also don't know where the strikes were set, so it's an open question I don't really understand is we can see for this trade, this is that 19-to-1 risk reward. We can see it's very binary. We've either got a 100% loss or a 1900% win. Even back in time, so we've got like a 1900% win back in June 2020. So I suspect somehow it's setting up with the same risk reward continuously. I don't know what that would mean in terms of actual the wing width, the spreads that it's got there. We're dollar wide on the wings here. I don't know how to get a 19-to-1 risk reward, where your strikes would be set to get that. We don't see that detail here. In this case here, we've got there's a few cases where we're not, totally in the money or totally out of the money. We've got some sort of partial wins here, so 1700%. Again, assuming it's also a 19-to-1 risk reward, that means we expired between the strikes, right? So we would have been, assigned shares in that case, either long or short. Here's a 320. When we lose, we're always losing at 100%. So when we lose, to the max. Again, I assume maybe it's some percentage basis, maybe the width. I don't know. Again, what the strike width would have been back at, when we're trading $40 as an example. What the equivalent trade would be. Again, we can't actually see the trade details here. So that's that. In terms of percentage move, we can see that chart here. This chart here shows us our percentage move. So here we can see that big move back in March 2020. Is visually, you can see it on this chart, unlike the other one. So this is where you would go. I did notice a defect here. When we click end of week, again, that's what we want to look at if we want to capture that entire period from trade entry to expiration, or from kind of earnings event to the immediate Friday. When I change it to end of week, I'm not seeing the same data that I saw on that previous chart, right? We said it was 10, 10, 10, and 7.8. I see that same data here. So the end of week price is 10, 10, 10, and 7.8. But it seems to be showing me it's plotting the 1 day. It looks like that's what it's doing. Yeah. So the chart's off. It's the data's correct in the pop-up if you're really looking for the end of week. But if you click on end of week here, you're not getting the same chart. So just keep that in mind. It's a new feature, so you can expect that there may be some kinks that haven't really fully been worked out yet. So always double verify anything, any data source that you're using. What else? So in terms of expected move, hopefully you come to some understanding as to why there's a low probability trade. Average move 8.3, more recently more like 10%. Expected move predicting 6.5. Let's see what that looks like on Tuesday, whether it goes higher or lower. Again, that's giving us more premium if it's a wider move or a bigger move. And we can set up our trade to actually be more in alignment with that expected move. The other thing I noticed is this out of the money percent. This is calculated based on the break evens here. Okay, so we've got a break even at 115 and 136, and that's pretty close, or that appears to be within our expected move, right? So our expected move is 6.5. We're a little bit wider, so our expected move is within where this trade is set up. Some people would do it that way. Other times you might want your short strikes to just make sure your short strikes are outside of the expected move. So here we can see, that the actual expected move is 115 to 136. So that's right where those break evens were. But we can see our short strikes actually aren't there. We've got a short strike at 117. So that's, again, expected move to 115 is going to be, we're going to be beyond our short strike. Again, if we're going to let this expire, then we would have an assignment. We're going to end up being assigned, especially if on a wider spread like this, we'll be between the strikes. So generally, you may want to, go a little wider, have your short strikes, make sure they're kind of further out to kind of avoid that risk of assignment. Same thing on both sides. It looks like both of them are going to be the short strikes are kind of, inside the expected move. So I don't think we have anything wider. They're all 8.3. No, here's a 7.9. Still short strike, a little closer, but again, expected move is probably right at the expected move, so not much leeway there outside. And you can see our risk reward is changing, right? The wider we go, right, the higher our probability, the worse risk we're taking. But this looks like a pretty decent risk reward. Again, if you want a higher probability trade, you're going to have to compromise in terms of your risk reward. So hopefully that's helpful. I think those are just kind of key things that I noticed. You may agree, you may come to different conclusions than me. Some of the things I mentioned may be more or less important to you. That's fine. Take it where you want to take it. I'm sharing this for information only. No need to respond. Wish you the best of luck in your trading, and hopefully put some earnings trades on in paper. Get some practice with some of these trades, and may your spreads expire out of the money. Good luck.